Get your free copy of the complete tutorial at www.teachucomp.com/free. Most of the accounts we have looked at throughout this tutorial have been considered temporary accounts. Temporary accounts are revenue, expense, and dividend accounts whose balances will be later transferred into a financial statement, specifically the retained earnings statement. Note that we will discuss dividends in future lessons. This happens because these accounts are used to record information for a specific accounting period. Permanent accounts are balance sheet accounts whose balances are carried forward to the next accounting period. Closing the books refers to the process of transferring the balances from the temporary accounts to the permanent accounts. It is also sometimes referred to as closing the accounts. Temporary accounts will be closed at the end of each accounting period. Permanent accounts are not closed. Here is a chart showing the list of temporary and permanent accounts. Temporary accounts include all revenue accounts, all expense accounts, and dividends. Permanent accounts are all asset accounts, all liability accounts, and stockholders' equity accounts. The closing process involves taking the revenue and expense accounts and placing them into an income summary. Then, dividends and the income summary are placed into the retained earnings statement. Closing entries transfer net income or net loss and dividends into retained earnings so that the balance in retained earnings agrees with the retained earnings statements. When companies prepare closing entries, they transfer the revenue and expense accounts to another temporary account, the income summary, and then transfer the resulting net income or net loss from this account into retained earnings. Here is a summary of the entire accounting cycle. The first step is to analyze business transactions. After that, the company will journalize these transactions and post them to the general journal or general ledger. Next, they will prepare a trial balance in order to check for errors. They will journalize and post adjusting entries if needed. Then they will prepare an adjusted trial balance. The next step is to prepare the financial statements. Step 8 involves journalizing and posting closing entries. And then finally, they will prepare a post-closing trial balance. Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.